Hey YouTube, thank you for joining. Today I'm going to be explaining a little bit about the Fed cutting rates and how that affects Bitcoin, altcoins, all right, so the cryptocurrency market in general, the stock market, the value of the US dollar, and that good stuff. So first off, I want to say I know a lot of you don't know too much about the Fed cutting rates and what that actually implies. And for the rest of you, or most of you that do know a little bit about it, it's mostly gauged off of what you've learned off of YouTube and social media. So I know this is a YouTube video, but I'm not some random guy that made a bunch of money on Doge in 2021 and didn't even know what Bitcoin was before that. All right, I studied economics in college, and my best class, other than the first, obviously, intermediate micro class, that's microeconomics. For those of you that don't know, micro is like domestic economics, so like for us in the US, and macro is the worldwide. So if wheat prices in Poland fall, we had to know how that affects US bonds. And so it's just a broad view of everything. But my best class, other than the first class, was international economics. And so that had a lot to do with currency trading. It was basically like advanced macroeconomics. And I did pretty well in that class. Our final paper counted for a good amount of our grade. And I got an A+ on it. It was the highest grade in the class, obviously. It was the only one, only A+. And I wrote it on Bitcoin and cryptocurrencies, and I will just put a transcript of that in the description so you guys can read it. It's called The Prudence of Cryptocurrency. So I'm going to start off with something so that everybody can kind of wrap their head around the situation in a macroeconomic point of view. So I want you to think about drinks, all right? Just drink sales in a hypothetical year, let's just say next summer. So in 20 years after posting this video, this is still going to be applicable because it's just a hypothetical year. It doesn't have to be actually the next following year. So let's just say the drink sales, and we're going to isolate that to summer sales, all right? So let's just say there's an estimated amount of drink sales that's going to take place, all right? And let's just say, for the sake of this example, that estimate is correct. So whatever they estimate the drink sales are going to be that summer, that's actually how many sales are going to take place. Now, let's say that in July, just out of the blue, okay, the year's already rolling, and they announce a big new music festival, a huge festival, you know, the Woodstock of the day, or Coachella or Bonnaroo for some other audiences. But anyways, let's just say there's this huge festival coming up, okay? And they announce it in the summer, and it's never been done before. They didn't have that in the expected value. Okay, so what's that going to do? It's obviously going to raise drink sales. All right, so if you were to go in and buy just all the drink stocks, you would be wrong because it's not going to raise every drink stock, but it is going to raise the total drink sales. All right, so let's say, for example, they have an exclusive deal with Pepsi, and so they only sell Pepsi products at this festival. Okay, so the total drink sales is going to increase. Pepsi sales are going to increase. But what's that going to do to the other drink companies? All right, so not everybody, but some of the people at that festival were going to buy a drink that day or that weekend anyway. All right, you have people that go to the gas station or McDonald's every single day and buy a Coke. All right, so some of those people are going to be at that festival and they're not going to be buying Coke anymore. They're going to be buying Pepsi. So Coke sales are actually going to drop a little bit, while Pepsi and the overall market are going to increase. All right. And for those of you that think like, oh, well, a festival, that's only a few thousand drink sales, so that's not really going to do much. It doesn't have to be a festival. That's just an example. You can use something more major, like say Disney built a mega theme park in the middle of the United States. They had beaches and roller coasters and all kinds of attractions, and they have an exclusive with Pepsi. All right. So that's obviously going to increase Pepsi sales and diminish the others, but overall raise drink sales. All right, so the Fed cutting rates. What happens when the Fed cuts rates? Now that we're thinking in macro terms, there's going to be an increase of loans because you don't have to pay back as much money, right? So you say, yes, I want to take out a loan. I want to buy a car. I want to buy a house. I want to, buy whatever we're buying. So that's going to happen. And to do that, there's going to be a fall in stocks. Now, why? Because it's not because the Fed rate directly affects stocks. It's because people need money. Like when I bought my Camaro, I didn't just have Camaro money lying around. I had to sell my stocks, and then I bought my Camaro. And so for the average Joe that isn't a stockbroker or a lawyer or a doctor or a day trader or, someone with a lot of excess money, they're going to need to sell their stocks. They might even need to sell their car or one of their cars or, something like that to be able to afford the down payment on that house or that new car. So there's going to be stocks coming out of the market. There's going to be sell pressure, all right? And when, let's just say, it could be 2%, 5%, it could be all the way down to like 30% or more. I think it's probable that there's like a 5 to 10% drop, but it's possible that there's 20 to 30%. And the reason that it can get bigger than that is because when institutions see something that's down 10, 20%, they don't want an asset that's losing 20%, especially when they're dealing with other people's money, okay, like mutual funds and stuff. So they're going to start selling. And so then things will get oversold. And so all that money is going to come out of the stock market. And it's not anything, directly to do with stocks. It's just the fact that people need money. So that's going to increase also the dollar value, the US dollar value, all right? So why does this happen? For the dollar, at least, there's foreign investment increase, all right? People see our rates come down, they say, yes, I want to get in on that, just like we do. And since we have a worldwide economy, people can do that. People are able to invest in the US stock market unless their country prevents them from doing so. So what that does is raises the demand for the US dollar. Okay, so people want it more, and it's also going to decrease the active supply. Not the circulating supply, but the readily available supply, all right? Because the dollars are going to be used. So both of those things are independently good for the US dollar. And together, they're very good for the US dollar, all right? So when the Fed cuts rates, you usually see some stock drop, and then you see the US dollar increase, all right? But what else do you see? With Bitcoin and altcoins, so let's just isolate it to two currencies, all right? Let's just say the US currency or the US dollar and Bitcoin are the only currencies in the world, all right? And so there's a set amount of money. And for the sake of this example, let's just say we're not printing US dollars at this very moment. So there's a set supply. So if the US dollar raises in value, that directly means that Bitcoin is going to decrease in value. All right, so the Fed cutting rates and the US dollar and going up and stocks coming down, that actually means, in this case, with the Fed cutting rates, that Bitcoin and altcoins and other currencies lose a little bit of value. They lose their share of those drink sales, right? So why does it actually go up in most case examples that we see? All these other people posting the graphs, they're like 75% of the time. So what happens there is all those institutional investors that sold because everyone else was selling, okay, they don't really need that money, right? They're not buying their new car or whatever. They already have a brand new Mercedes or a Porsche or whatever. And so that money, and a lot of times it's not their money anyways, it's the mutual funds money. But anyways, so that money is then going to go to other assets that are oversold. And in this case, in today's scenario, that is going to be altcoins. They're oversold. They're near bottom, most of them, okay? Some of them obviously have already skyrocketed and hit new highs, but many of the altcoins are still near bottom. And so they're oversold, and it's a good buy price. And so this isn't financial advice. This is just what happens when the Fed cuts rates. And so knowing what I know, that's how I'm going to play it out. I am buying altcoins. And like I said, this isn't my first go around either. I studied, economics and Bitcoin. I've researched it for years. I was looking at it in 2016. The first time I bought it, it was like $9,000. I traded 2017 bull run, the 2021 bull run, and now I'm trading this bull run. And this is what I think is going to happen. So this is what I'm doing with my money. But you shouldn't go off of what I say. You should take everything I've said in this video and look it up and, decide if those are reliable sources and see if it comes out of a textbook or out of a news feed, and make your own decisions and make your own calls and investments. So that's what happens overall when the Fed cuts the rates. You're going to see stocks fall because in the current economy, well, usually in this case, in the economy, we need money. And so where do you get that money from? Excess money, like stocks. So you're going to see that fall. You're going to see the US dollar raise, and you're going to see other currencies fall a little bit. But in some cases, that excess money is going to it's going to get moved and it's going to turn around into other assets, which in this case just happens to be things like altcoins. And a lot of people say, well, why not Bitcoin? It's better performing. Well, that's exactly why not Bitcoin, all right? Because it's already seen like right now, it's already seen like a ×8 return. So for institutional investors, that is not a safe investment. For anyone, that's not a safe investment. That's pretty high. So you don't want to do that, especially when dealing with other people's money. It's one thing to lose your own money, but it's a completely different thing to lose someone else's money. All right, then you're responsible and people hate you, and it's a terrible deal. So you don't want to buy something that's ×8 in value already. You want to buy something that's sitting near the bottom that has intrinsic value that you think will actually go. All right, so a lot of these altcoins are trash. They don't do anything for anyone in the world, and they have no real value. But then there are other coins that do have value, and like XRP, and that's one of the ones that's already up here, but that's just an example. Like XRP has real world value, right? It's a banking coin, so people will actually use that to make transactions and do things. The exchange coins, right? You need the exchange coins because you need the exchanges. So things like that. That's what's going to happen. That's how it happens. That's how the Fed cutting rates affects the dollar, affects stocks, affects cryptocurrencies. All right, it's not direct relationships for most of these things, but it does have an effect. We'll see, in 100 years, there will probably be a lot less correlation between the Fed cutting rates and Bitcoin because the price of Bitcoin won't be so volatile. There will be more investing, more worldwide acceptance, and so the price will stable out a little bit. It'll keep going. Probably my prediction is it'll keep going up because of the set supply and growing population and things like that. But eventually, it should level out more, and the fluctuation shouldn't be 80% and these ×8 returns and all this stuff. It'll just be like a normal stock making 10% a year or something like that. So, and again, it shouldn't be compared to a stock, but I was just a normal investment. Yeah. So I hope you guys enjoyed this video. I hope you learned a little bit about investing and the market. And you should definitely study macroeconomics and economics in general. It really helps to understand things and see things from an objective point of view and not get so caught up in, the story and the media and other people's predictions and all these things. Because you can just look at the numbers and look at the scenario and be like, well, that's true or that's false. And that's how I'm going to play it. So thank you for watching and have a good one.